Hey there, ReAnn Gonzalez with Edge Home Finance. Let's talk about something you've probably seen all over builder ads lately. Get a 4.99% mortgage rate. Meanwhile, the rest of the world is sitting at mid-6s to 7s. So, what gives? Is this a scam? A secret hack? Not exactly. It's a strategy, and if you're thinking about buying new construction, you need to understand what's really happening behind the scenes. Okay, so now let's get into it. Here's the deal. Builders are sitting on a lot of inventory. That means they're paying holding costs, taxes, insurance, and interest on every unsold home. But here's the thing. They don't want to drop prices. Why? Because price drops can hurt the value of the neighborhood and upset buyers who paid full price last year. So instead, they offer you something that feels more attractive, a lower interest rate. So, what is a rate buy down? It means the builder, or more accurately, the builder's preferred lender, is paying upfront to temporarily or permanently lower your mortgage rate. So yes, that 4.99% rate, it's real. But it's not free. Depending on the home price and terms, that buy down could cost the builder anywhere from $20,000 to $40,000. And they're not giving that away out of the kindness of their heart. They're either baking that cost into the sales price or requiring you to use their lender so they can recover some of it, or possibly a combination of both. Now, is this a bad thing? Not necessarily, but there are trade-offs you need to understand. You might be overpaying for the home because the builder didn't reduce the base price. They just disguised the cost through the rate. The lower rate might only last 1 to 3 years if it's a temporary buy down. And after that, your payment jumps. So you need to check and find out, is it a temporary buy down or is it a permanent buy down? You might have to use their lender, which means you're not shopping around to see if there's a better deal. And it may be harder to build equity quickly, especially if the market softens. It's very similar to when you buy a brand new car and you drive it off the lot. There's the old saying that it's not worth what you paid for 10 minutes ago because it's gone down in value as a resale. Very similar in a new construction, so it's something that you might want to compare between a new build versus once you buy it and you were to try to resell it within the first 6 months or a year. Is the equity still going to be there, or based on the resale market, are you upside down? It's something you need to take a look at. So, why do builders do this? According to recent data, over 60% of builders are offering these kinds of incentives, whether it's buy downs, closing cost credits, or even free upgrades. Why? Because it works. It keeps their sales numbers up without lowering prices across the board. Here's what I tell my clients. Always compare. Sometimes a slightly higher rate and a lower home price, maybe from a resale or a different builder, can actually put you in a stronger financial position long term, especially if you're planning to move again in 3 to 5 years. If you're looking at new construction and seeing these offers, let's sit down. I'll go through the numbers with you line by line so you know exactly what's real and what's marketing fluff and what works best for your goals. Because that 4.99% rate might sound amazing, but the math never lies.